Welcome to episode 1 of my trading journal. This is a recurring series that I will be doing once a month, drawing a hard line to see exactly how much cash our money factories generated. We are tracking this portfolio strictly in percentages based on cash flow and capital allocation. For the month of May, our total capital allocation is $5,000. Let's dive straight into the companies. First up is Coca-Cola. I bought a long-term LEAPS contract expiring in January 2028, which allows us to sell short-term options against it. For the May cycle, we sold an $83 short call expiring on May 29th for a $28 credit and, disciplined as always, closed it out on that exact expiration day for $8 to eliminate weekend risk. This leaves us with a clean $20 net profit in cash for May, which is a 1.4% cash flow return, strictly on the capital locked in Coca-Cola. The machine is already set up for next month, as I just locked in a fresh $56 credit expiring on July 17th. Next up is Bank of America. I have a long-term LEAPS here expiring in January 2028 that cost $1,060. Bank of America was a cash machine this month, locking in 2 full trades. The first short call closed on May 4th for a $28 profit, and the second one closed on May 20th for an additional $11 profit. That's a total of $39 in pure cash flow for May, delivering a massive 3.67% return on our Bank of America capital. Next up is Colgate-Palmolive, where our long-term LEAPS contract expires in January 2028 and cost us $1,510. Colgate-Palmolive is the ultimate textbook example of how to turn defensive risk management into a pure credit-generating machine. During May, the stock made a strong move upward, putting pressure on our short call. Instead of panicking or taking a loss, I executed a flawless defensive roll on May 19th. I bought back the front-month option and sold the June 19th $91 contract, capturing a clean $24 net credit in the process. Just 10 days later, on May 29th, I rinsed and repeated. I closed out the June cycle and rolled the position further out into the July 17th cycle at the same $91 strike. Because of the extra time added, the platform paid us another $47 net credit. By simply defending our position and kicking the can down the road, CL generated a combined total of $71 in pure, realized cash flow for May, delivering a fantastic 4.7% return on our allocated Colgate-Palmolive capital. Then we have Visa. On May 20th, I deployed a quick bull put spread at the 300 to 305 strikes, collecting an upfront $48 credit. Visa moved perfectly in our direction, allowing us to buy back the position just 9 days later, on May 29th, for only $25, locking in another $23 net profit in cash. This represents a fantastic 5.08% cash flow return in just 9 days on the capital required for this trade. In total, across all positions, our money machine generated a grand total of $153 in net realized cash flow for the month of May. Measured against our initial $5,000 capital allocation, that means we locked in a phenomenal plus 3.06% total return for our very first month. But here is the exciting part. For the month of June, we are scaling up. I have officially deposited new funds into the account, expanding our capital base to take on bigger, higher premium opportunities. On top of managing our core winners like Coca-Cola, Bank of America, and Colgate-Palmolive, we have officially deployed new capital into heavy hitters. We opened brand new, long-term LEAPS plays expiring in January 2028 on Johnson & Johnson, the long-term Treasury bond ETF TLT, and the financial sector, ETF XLF. The machine is now twice as big. The risks are managed, and the summer premium is waiting to be collected. See you in the early July portfolio update to see how June performed.